Well, over the long term, the S&P 500 has essentially grown about 10% per year. And we think that in 2017, with all of the improvements coming out with regards to lower taxes, potentially less regulation, growth initiatives in infrastructure, and essentially repatriating cash offshore, we think that the growth rate in the U.S. from a GDP perspective could potentially accelerate. And this has been something that we haven't seen in quite some time. So going from 1 to 2% to potentially 2 to 3%, maybe even a 4, I think is going to be very good for U.S. equities. And this will potentially drive higher earnings, which then, of course, drives higher stock prices. Well, if you look at the overall valuations for the market now, on a forward 1-year basis, we're basically at 17 times earnings. So this is almost just in line with its 20-year average. However, what we do see is potentially for earnings estimates revisions to the upside given lower tax rates, faster growth. The risks out there would be around really what is going to happen with the border tax potential regulation. Some of the things that have been put forward in Congress to help pay for lower tax rates, you need to make that revenue up somehow. And that, I think, is cooler heads are going to prevail. Basically, Donald Trump has surrounded himself with business people in his cabinet, and we think essentially cooler heads will prevail with regards to not making a radical change that would disrupt the markets. So we are encouraged from what we see.